This Week in the Boardroom, brought to you by corporate board member and host NYSE Euronext, along with governance knowledge partner, the Center for Audit Quality, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of This Week in the Boardroom. I'm TK Kerstetter with Corporate Board Member, and it's my pleasure to welcome you to what's going to be a very unique interview today. We're actually bringing This Week in the Boardroom from the annual conference for the Society of Corporate Secretaries and Governance Professionals, and we're privileged to have a guest that actually kicked this conference off this year by being the keynoter, and that's Ralph Whitworth, who's the founder and principal of Relational Investors, and is also a board member currently of Hewlett-Packard, but has served on the board of over a dozen companies over your career. And Ralph, welcome.
Thank you, TK. I'm happy to be here with you.
Well, I think the good place to start is while you're well known in this industry, I think there's going to be viewers that maybe aren't familiar with Relational Investors or exactly what you do. The reputation of the firm and you is that you're not afraid to be an aggressive shareholder. You want to make sure that you can make a change relative to shareholder value and not afraid to speak up. So why don't you tell a little bit about the company yourself and then a little bit more about what a company can expect when Relational takes a position in the stock.
Okay. Well, my partner, David Batchelder, and I founded the company about 17 years ago, and we were a pioneer in this investment strategy. For lack of a better word, and not to try to fight labels, some people call it activist investing, but that covers a whole range of different activities. But essentially what it is we take positions in publicly traded stocks out there in the stock market where we think that the value of the company is undervalued against its potential, based on a program of change that we plan to recommend to the company. So examples of some of our projects have been Home Depot. We had a big project there that was very successful. They have a great management team. We're doing a project today at PepsiCo, which is working out very well. You mentioned HP, where I'm on the board. There's been 100 projects or so over that 17 years. And they've been quite successful. And all of them, when I say a project, involved an investment that we made where we thought we could become part of the value proposition. Now, as far as what a company can expect, usually it's just a knock on the door, a polite knock on the door, a request for a meeting that says, hey, we own some stock, we'd like to talk to you a little bit about sort of where the company's going, and yeah, we probably have a few recommendations. But at that stage, those recommendations are usually more set up as a challenge so that we can sort of get the feedback and also help validate our thesis around the company. And then of those companies, those 100 or so projects, there's only a dozen or so, if you Google us, that you would see come up. So what that says is that most of our projects, we work with the companies behind the scenes. It doesn't become a big thing in the press or out there on the street, and it's a constructive sort of series of communications, and invariably the companies move in the right direction. They don't always work out for us as investments, but the majority of them have.
It's not often that I get somebody to talk about this next issue, and I know in your keynote you talked a lot about executive compensation, and it still needs a long way to go, not just because of the ratcheting up, not because we have a 30-page CDNA in the proxy, but it's just still a lot of work to be done. And say on pay, I think helps, but it also creates a situation, and the situation is one of the things I want to talk to you about. When, obviously markets cycle. We have up markets, we have down markets. We enjoyed a wonderful run of about 10 years where people made a lot of money. But now we're in the kinds of markets that are typical, up and down. And you're going to have down markets, not to the extent that we had in the financial crisis, but that's still an example of where things will happen globally that put a lot of pressure on companies. And in some of those situations, a management team might, I say might, do their best performance, meaning they move market share, they move up in their peer group, they save the shareholder, maybe tens or hundreds of millions of dollars, and prepare the company to shoot forward when the conditions change. Yet, comp committees have this optic problem of rewarding management during a time when stock price is down and earnings are down. Yet, there has to be a level of courage, even with say on pay, to say, I've got to retain. This is a wonderful management team. You've served on comp committees, okay? It's a optics and a compensation committee dilemma. What do we do?
Well, what you do if you're a board out there, and there are some companies that do a really good job of anticipating the cyclicality, the natural cycles that all businesses go through, and build that into their compensation programs. So Deere, the tractor implement manufacturer, if you look at their comp program, somebody wanted to look at, they have a program that where they talk to the investors about how they're going to compensate and what the metrics are going to be in the down cycles and the up cycles. So a lot of this optics issue and the disconnect and disenchantment that you see out there among the shareholder base is when they get surprises, or when it's obvious to them that management has made missteps and they're still getting paid well. They're sophisticated and they're practical at the end of the day. Now, some of the audience out there might say, well, geez, show me where they are, but they really are. Investors, they just want to make money on their stock. They understand that there's cycle. They understand there's risk. They understand the challenges. So a lot of it is communication. So, as a board member, I wouldn't be shy at all, or as a comp committee, about going out there and saying, hey, we're going to be in a challenging environment here. We're actually going to be losing market share as part of our strategic program, or some shift in the dynamics of an industry. Our management, it's going to be important for our management team to do, these 3 or 4 things to manage that, and we're going to compensate them for that if they do a good job. And if they do that, and if they explain that, they're not going to get flack if these folks make a decent money or even some extraordinary pay as a result of that. But if you're in a down market, everybody's going to have to suffer, even those that are doing a good job, because it's just the nature of the markets. It's the nature of how investors think, and I think it's human nature. So when things are good, things are going up, people are going to be less concerned about a little bit of extra pay or some extraordinary pay. But when things are tough, even when you're doing a good job, you might have to struggle on a little bit less in terms of your compensation, and you're just not going to get around that.
Yeah, it is frustrating though. I know we're on the same wavelength, that some people do get rewarded in the upcycle when they really have not done anything. They're rising with the tide, they get the benefit, but when other people are benefiting, there's less focus on.
And a lot of the money that was made in the 90s, and if we go all the way back to the 80s and even the earlier part of the last decade, was just that. All ships were rising, and I think there was a backlash around that. And the stock options were paying out, but as a group, corporate America has done a very poor job of managing the optics and of managing the practical aspects of compensation. I mean, if you look at the way executive compensation has escalated over the past couple of decades, it is the smoking gun that there's something wrong in the boardrooms and there's something wrong in our governance milieu.
Well, certainly that time of that 10-year run, when you talk about ratcheting, if it ever ratcheted, that was the platform to ratchet. And I think when it was difficult to unratchet it. Well, let me ask you another question. I'm going to shift gears here just a little bit. I want to take advantage of your years of serving on boards and wisdom. And one of the things that's very important for a company is sort of the governance foundation that one establishes, that especially in tough times, that is very, they should be very reliant on, that sort of gives them a good solid base. If you were looking at a company that just did an IPO and you had a board that was going to go public and you had a chance to sit with that board, they asked you to come in, they say, give us the 2 or 3 things that will make sure that we've established a good foundation as a board of directors, what would you tell them?
You know, I would tell them to focus on the dynamic in the boardroom. And you know, it's again, we talk about human nature, but it's human nature when, you know, you've been chosen and there's been deference to you as a board member by this group to sort of go along, for lack of a better word. And if you look back at the history of many of the scandals we've had, if you look at some of the fundamental problems that we had leading up to the financial crisis, you can trace that back to boards that were populated by good people with good integrity and high intelligence, but for some reason just the dynamics were such that they weren't reacting to some pretty strong signals and maybe weren't asking the right questions. So it's hard to do, but say, do we have the right dynamic? Do we have that maybe irascible devil's advocate type around the boardroom, or maybe even a few of them? And are we going to respect them, and are we going to understand, you know, that that's something that is important to the dynamic in this room? So for me, it would be, yes, you know, let's have independent directors, but let's try to make sure that they're acting independently. The second one is, and this is just as important, make sure you're using your time right and manage your time. I think that's the thing that boards do the poorest. They defer too much to the general counsel's office or maybe even management to set the agenda for the board meetings, and they come in and they're just reacting rather than setting up a situation where they can be more proactive. So make sure there's a good balance between the process-oriented functions of the meetings that we have to have, and those where there's room for true interaction and where you might be able to elicit some insights that could be helpful to the company going forward.
I would bet if we went back and looked at great boards, all of them have done a great job of structuring their time.
That's the thing that, I mean, how many times do you come to the end of a board meeting or any meeting when you say, oh my goodness, you know, we really haven't gotten to the punchline here, and now the clock's hitting us, and that presentation was very poorly organized and it went way too long, and we didn't really get to ask a question. And then you're flying back on the plane saying, gee, I wish I would have asked these 5 questions. And so, time management.
When you look at boardroom trends today, what trends sort of encourage you about corporate America and their boardrooms, and what sort of trends concern you? So what encourages you, what concerns you about today's boardrooms going forward?
Well, I'm encouraged that boards are more responsive, it appears to me, to investors, more responsive, more quick to react when things are drifting in the wrong direction. I think that comes from a number of things, but primarily from the injection of more independence into the boardrooms. So that's been encouraging. What's been discouraging is that hasn't happened faster, and that the composition of the boards are not evolving, I think, with the times and the process for composing the boards. We've had a giant shift in the ownership of corporate America over the past several decades. It's shifted to fiduciaries, away from individual ownership, founder ownership, and maybe it was in the trust departments of banks. Now you've got much more sophisticated institutions. They have fiduciary responsibility, they have research capability, a different shareholder base, but the composition of the boards and the way that the boards are composed has really not changed much. And I think, and you know, the investors, shareholders need to be a bigger part of that process, and I think that would be healthy. And the boards should reach out proactively and try to involve them more in that process. That's healthy. That would be healthy.
Well, we've certainly seen that, as you say, we've certainly seen part of that happen ever since the crisis Dodd-Frank. I mean, say on pay. Say on pay was a big example of having a voice.
But you don't want to wait until you see a scandal and a crisis like we see at Chesapeake, where then the investors get involved and shake up the board and have a lot of input. You know, you want to do that much earlier as part of some ongoing process. And it's a tough one to get at, but I think it's important to corporate America going forward.
Ralph Whitworth, thanks for joining us. It's been great to have you on the show, and we appreciate you joining, and that will conclude this edition of This Week in the Boardroom. This was a special show again from the Society of Corporate Secretaries and Governance Professionals annual conference. We hope you join us next week, where we'll take a look at another critical issue that'll help you be a better board member and a better committee member. We'll see you then.
Join us again next week for This Week in the Boardroom, brought to you by Corporate Board Member and host NYSE Euronext, along with Governance Knowledge Partner, the Center for Audit Quality, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.